And we touched everything when we purchased the property. There was being drugs run out of there, prostitution, like it was a pretty rough property. So we took the property down to zero occupancy, completed our renovations, and then brought it back online.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 239. My guest today is a big fan of the Keanu Reeves movie, The Matrix. And he believes that most people really are living in the Matrix, and it's his job to help them escape. And he does this by teaching them the benefits of multifamily and apartment real estate investing. Since leaving a successful corporate America career, Jerome Myers has become a thought leader in the multifamily development space. Jerome leads the Myers Development Group, which focuses on buying broken apartment building businesses and using innovative thinking and solid execution strategies to optimize the operational efficiency of the business. Jerome asset manages 90 units and 90,000 square feet of workforce housing across Virginia and North Carolina, and he's on a mission to hold 1,000 doors in the next 8 years. He also hosts the podcast, Myers Methods Presents Multifamily Missteps. Jerome, welcome to the show.
Brian, I'm so glad to be here. I don't know what to do. And if that introduction doesn't get somebody excited, I don't know what will, man. Thanks for having me.
You are welcome. It's great to have you on the show. Why don't we just start with you telling us a little bit about yourself and how you got started investing in real estate?
Oh, man. So I guess there's a bunch of different first deals, right? But, just at the base, I'm a son of a soldier and a stay-at-home mom. Lived in the same house, even though I'm a military brat. Went off to college, got a civil engineering degree, and then went to the power company and started the American dream, or at least that's what they tell you. Eventually, I left corporate America. I dropped out after building a $20 million business. And while I was making what I thought was a pretty high income, I started lending money to fix and flip investors. That gave me my opportunity to kind of look behind the curtain and see what was going on. And when I decided to leave corporate America, I decided, hey, I'll just go do that. But that wasn't without me trying something else first. And if I think back to college, a friend of mine and I were sitting on the stoop, and we did what engineers do in their free time. We were doing math. And so I multiplied what I was paying plus what my two roommates were paying. And then we added in what his unit was paying. And then we multiplied by the whole complex. And we realized that the owner of that property's top line revenue was about $700,000 a year. We never seen him. We never talked to him. He had third party property management in place. And, it was like he figured out how to decouple his time from money. And so we wanted to do that, but we didn't know anybody. We didn't know how to get into the space or any of that stuff. So we went down the traditional path. When I decided that I was leaving corporate America, I decided to go back to that. The thing that I ran into a brick wall with is I didn't have any experience, and I didn't have anybody in my network that was willing to lend their experience to me in order to get into the business. And so I went and started fixing and flipping. And fortunately for me, an investor that was investing in the same neighborhood pulled up one day and started looking at the property that we were working on and asking questions. And in small talk, he mentioned that he was getting ready to buy a new apartment building.
Let me stop you right there. Okay. And we'll come back to that. Let's remember that moment that you met an investor who brought up the idea of apartment investing. But I want to go back to two things that you just said and kind of dwell on them for a moment. One was you were in corporate America making pretty good money, kind of had the golden handcuffs as we refer to it. But you had the awareness that, hey, you could make better money, probably with less work or less effort without having the 9-to-5 job and the W-2 income through real estate. You started doing the hard money lending. But then the other awareness you had, and let me make sure I got this right, you were living in an apartment complex and you started doing the math on how much the owner of that apartment complex was making?
Yeah, so that was in college. We were sophomores in college. At that point, I realized, hey, I didn't want to get a job. right? And it was like, how do we not get a job? And I think it was really at that point that I realized you don't actually need a job, you need an income stream. And so when we looked at what was happening with the property owner and his situation, how he was making money, we wanted to do that. But, it goes back to my roots, right? Like we didn't have attorneys, doctors, business owners coming over to our house for dinner. My dad was a enlisted man. He was a soldier. And so, this was just my exposure by, going out and exploring the world. And yeah, what I realized kind of the hard way after I left was fixing and flipping was just another job. You have to do the transaction. You're continuously going to Lowe's and picking up material and doing a lot of the other stuff unless you get to a place where it's systematized and you got a lot of employees. Part of the reason why I left corporate America is because I built a really big business, well, at least what it was big to me. We were doing about $20 million in revenue. And we went from 0 employees to about 175 over the course of about 8 months. And each year we had to lay folks off. And the first year I promised myself I would never do it again. The second year is when I decided that I was going to exit because it didn't look like I was going to be able to avoid what was a traumatic experience for me.
It was that negativity of having to lay people off, seeing that people's jobs were somewhat transient. Here today, gone tomorrow. But in the meantime, you must have felt a lot of pride and effort and just the fact that you had helped build this $20 million business.
It was extremely exciting and rewarding. I mean, I worked tirelessly to make it go. I was fortunate enough to not have direct oversight. My supervisors lived in different states. At one point, one was in Texas, another was in Kansas City. And so it was me at the tip of the spear leading and building this business. So it gave me the opportunity to be an entrepreneur without the pay cut. And then I actually took the pay cut when I left and started doing the real estate thing full time. And it's always interesting when I hear folks who want to make the transition to real estate entrepreneurs say, well, I'm going to build up my business or my cash flow to replace my income. And what I tell them most frequently is you don't need to replace your income. You need to be able to replace whatever it costs to pay your bills. Because if you can pay your bills, then you can get free. And then you can go off and spend that time that you're using at your employer to build something and scale the business that you want to move into.
That's a good point, especially if you have a high-paying job like it sounds like you had. You may have been making a lot more than you needed to actually pay your basic bills in order to leave your job. And I see that quite often, like people who get into real estate, they have good-paying jobs or engineers or doctors or whatever. And they feel like, well, they need to replace their $100,000, $200,000 a job, but that's not necessarily the case.
Yeah, and I was fortunate enough to break six figures when I was 26, right? And so I was making really good money. It's not like I was around the national average for income or anything for the household. I was doing really well, but what I did do was I stopped growing my lifestyle, and that was an intentional choice. And so I was being aggressive with savings. I was being pretty frugal, although I had some things that I enjoy. I'm a car guy, so I had a few cars along the way, but those weren't necessities. And what I found after leaving is you don't really miss that stuff. A lot of the things that we buy is to rationalize the sacrifices that we're making by doing work that we're not passionate about.
Did you leave the job to go do flipping and fixing full time?
I left the job thinking I was going to go buy an apartment. And so I started the ramp up period, but I didn't do enough education up front to realize I didn't have any chance of actually buying an apartment with bank financing in my current state. I went to the banks. I was like, hey, I got an MBA. I just built this big business. I'm a licensed engineer. I'm a project management professional. I was just going down all the credentials, and they didn't care about any of that. Their point was, you don't have any experience doing the thing that you want to borrow money to do. And they were absolutely right. And had I been able to get that loan by myself on that deal that we eventually did, I would have bankrupted myself because my budgets were off. And I didn't have enough. I didn't have enough cash in order to fix the project when it went off the rails had it been just me by myself.
So the bank was really looking at your track record and saying, well, you have no track record, so we don't trust you with our money. How did you then convince them? Obviously, you ended up buying an apartment building. How did you make that work without a track record?
So we went back, and that investor that pulled up on that fateful day when I was sitting on the porch and started talking to me about the project mentioned the exact same project that I tried to buy 4 or 5 months earlier. And through that conversation, I figured out a way to actually become part of the partnership that bought that project. And so that's what it is. It was borrowed credibility. So one person was in as a general contractor. The other guy was the money and the experience partner. We had a property manager come into the deal. The broker that was marketing the deal actually put some money in. And then I came in as a project manager.
So there were quite a few people involved in this deal then.
Yeah. So we ended up, it was first the 3 amigos, and then it turned to the band of 5.
And how did that help you with the bank? Did the bank then take another look at you and say, okay, well, you've surrounded yourself with people who obviously know what they're doing and have a track record, or how did that conversation go?
Yeah, that's exactly what happened. And then we had some folks that were, the experienced partner had access to resources that were much larger than what the rehab project we were doing was going to be. So, they felt comfortable that they had collateral not only in the building, but in cash that they could pursue if something went awry.
So let's talk about that deal a little bit. Tell us the particulars of it, since it was your first apartment deal. What all did it require as far as money, financials, how many units, and what did you bring to the table?
The deal in itself, we bought 23 units in a growing part of Richmond, Virginia for $1.27 million. We were able to get a construction line of credit to do the rehab. I can't remember exactly how much that was, but all in all, I think the initial loan was around $2 million, maybe 2.5. We went in and we did everything. The property was renting for $695 when we purchased it. Today we rent it for $1195.
So one unit was $695, and you've improved it to the point where you're getting almost $1,200 per unit?
That's correct.
That's fantastic.
Yeah, but I mean, it was painful, right? And we touched everything when we purchased the property. There was being drugs run out of there, prostitution, like it was a pretty rough property. So we took the property down to 0 occupancy, completed our renovations, and then brought it back online. Brian, we did everything: roof, siding, added a first floor, half bath and laundry room, took out walls on the first floor, granite countertops, appliances, new cabinets, paint throughout, new flooring. Like there wasn't a surface at the property that we didn't touch. I think the only thing that's probably remaining that's original are the majority of the windows.
So how did you know that this property that was such a rundown den of crime and thievery and prostitution, how did you know that this would be one that you could improve and get higher rents on?
So this area gentrified pretty rapidly. When we looked at the neighborhood and we saw what happened to houses that were selling for $200,000 at one point, were selling for over $400,000 in the current environment. And so it was like, this area is path of progress. There's a lot of people who have interest in this property. It's really convenient to downtown. And, everything around it was going well. I think, so we were buying basically the ugliest house on the block, taking one of those fix and flip principles and applying it to multifamily. The thing where I think most people get in trouble is they try to take a property that's in a poor location and fix the property thinking that's going to change the location. If you're in a great location and you fix the property, you're in a much better position than the other way around.
What was your part in all this? What did you bring to the table, and how did that work out for you?
So we bought a percentage of the down payment. I think we total raised about $450 for this deal between the partners. And then my contribution is being asset manager. So I was helping with construction and just overall operations of the business to try to make sure that, we stayed on path. We made the right strategic choices. And honestly, the the business plan and the approach is the one that I argue for. At one point, we considered just throwing lipstick on a pig, but I was pretty forceful in the conversation about trying to do a total makeover or renovation of the property so that we could enjoy some of the rents. And I'll be honest with you, it's exceeded our expectations. We were expecting to get $895 or $995, but when we went to market at $1195 and was able to get adoption, we were ecstatic, honestly.
It's great that you were able to prove that concept. The idea of let's put more money into it, really turn these into nice high-end units. How did you back that up with data or an argument that won over your other investor partners?
What we saw was that there was a gap in the marketplace. Everything was just kind of halfway done. The majority of the homes in the area are historic. And so people tend not to put a lot of money into the historic homes. They just want to kind of patch it up, get it good enough, and then move on. So we wanted to come in, attract a target market. There's a hospital downtown. And so this area is perfect for...
But where are we talking anyway? What city?
Richmond, Virginia.
Richmond, Virginia. Okay.
And so, there's a medical college downtown. And so this was kind of the ideal property type for somebody that was in that type of lifestyle. And then I think there's like 7 or 8 different Fortune 500 companies there. And so we wanted to create a place that was affordable, and because it's not quite downtown, but just outside of downtown, to attract those young professionals.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Was this a historic building, or when was it built?
The building is not historic. Parts of the area are historic. And to be honest with you, we avoid historic buildings because of all of the regulations that go along with them.
How many units are we talking here?
23.
Okay, 23 units. Are you still asset managing that? Have you pulled any money out? I mean, how has that turned out for you?
Yeah, we just finished the refinance on the initial construction loan. Eventually, we're going to go to some probably permanent non-recourse debt, but we just stayed with the community bank that funded the initial purchase and construction funding. Just kind of flipped the loan over, but I do expect us to refi again and pull some money out and go into some of this long-term agency debt.
As asset manager, how are you communicating with your residents about COVID-19 and their ability to pay?
So we're just asking for them to be communicative. If something happened and they've been impacted, let us know, provide proof, and then do their part, right? We want them to file for unemployment. They want them to make sure that they file their tax returns. And if they're doing those things, then we've got the ability to be flexible with them. For the folks that aren't being transparent and maybe just trying to take a ride for free, we don't extend those same courtesies to those folks. And so if they haven't paid and we need to take them to eviction court, we will. I mean, the fact of the matter is the stimulus is there for the people that are adversely impacted, and the people that are not adversely impacted still need to pull their weight, because if they don't, then they adversely impact not only us as owners, but the other residents who have to kind of bear the brunt of the struggles that we have from people trying to take advantage of a tough situation, even though they don't have the impact.
I'm wondering, when you first acquired this property and you said that there was all kinds of crime and prostitution and drugs going on, how did you confront that? And give us some examples of maybe some uncomfortable conversations you had to have with some of the existing residents.
I think probably the most uncomfortable conversation we had was when a resident who was elderly died in her unit, and her family had to come and take her body away, and they just wanted to leave her stuff in there it was almost 3 or 4 weeks. And so when it came time for us to actually clean out the unit and move on to somebody new, well, actually, I think we were getting ready to renovate it at that point. Uh, they weren't happy that we were trying to move on to the new space. They wanted things to stay as they were, and they weren't willing to pay the rent. And so eventually we had to have that conversation that you either have to do something with the property or we're going to discard it.
That's an interesting argument to have with someone who says, well, we should keep, even though that person is no longer alive, we should keep their stuff in this apartment and not have to pay rent. What was the thinking there?
Well, I think it's just emotion, right? If it's grandma's things should be the way they are. I used to come to grandma's house. We have breakfast or tea or whatever. And, they just won't like the thought of being able to go to grandma's house, even though she didn't actually own the house she was renting. So, people, I think, especially around death, are become irrational. And, we just have to bring them back to the reality of the situation while still trying to be kind and patient.
How do you personally handle those types of conversations?
I think we just learn where people are and then come to that place where they are and build from that common place to explain our perspective and then ask them to be a participant in the solution of the situation. So there's nothing about this is personal. It's just, all right, here's the challenges that we both have to solve. And if we can come up with a plan to solve those together, I think they work out really well.
And then what were some of the lessons you learned from going through this process on your first apartment complex?
Picking your partners and making sure you guys have aligned values is the most important thing that you can do. Because you rig the project for success. You can have disagreements about strategy and approach, but if you're questioning about whether somebody's being honest or if they're being transparent in their actions and that type of stuff, that will erode goodwill when it becomes time to make some other tough choices. And a lot of people don't actually have this conversation, but getting into one of these joint ventures, they're longer range, and it's very much like getting married. You're tying your financial future to that of other people that are in the deal. And so it's always interesting for me when you just meet somebody and then you jump into a partnership with them and you wonder why it doesn't work. And you haven't even done the hard work of really getting to know the person that you're partnering with.
It sounds like there were at least 5 different players. And was it a joint venture? Is that what you guys did?
Yes.
How many people were in this joint venture with you? And how did you know you would get along, or did you have some conflict that you had to work through?
No, we absolutely had conflict, from strategy on how we're going to execute the plan to, the actual execution and how quick things went and how slow things didn't go. And I mean, there's always conflict along the way. People always everybody has a perspective and you have to work through that.
Give us an example of some of those conversations.
The fundamental one on whether to put lipstick on a pig or do a total rehab. I was adamant that the only way to do the project was to do a total rehab. Other folks who have seen people successfully put lipstick on a pig and then remarket the property for big gains were pretty adamant that that's the way we should go because it had the least amount of risk and the highest potential profit. And so we had to work through what was actually workable. And what it really came down to was our biggest partner, which was the bank, and saying what story is going to excite our debt partner the most. And it ended up being the actual doing the total rehab.
That's interesting. You just said what story is going to excite our debt partner the most. And I always say that. I mean, when you go to the bank, you don't just show them the numbers and the deal. The most important thing, in my opinion, is telling the story. What is the story of your vision and what you plan to do? Where has this property been and where are you going to take it? And it sounds like you were able to tell a compelling story.
Yeah, Brian, I think that point is very poignant, right? If we would have, because the person that owned the property before didn't actually execute the business plan, they just kept draining it and putting supplemental debt on it and refinancing and pulling more money off of it. They let the quality of the property erode. And when we came in and told them, hey, we're going to make this the crown jewel of this neighborhood, they started smiling and they got really excited about the ambition and vigor that we had about the project and having the actual resources to back up what we were going to do if something went wrong. So, fundamental execution plan was one of the biggest points of conflict along the way.
When it comes to joint venture, what advice do you have for listeners? First of all, tell us what a joint venture really is. Because typically I do syndications. So I've joint ventured with one other investor on one-on-one type deals. I've never joint ventured with 5 people in the joint venture. Usually I do a syndication, and it's a little different legal structure. But tell us what a joint venture is and why you prefer those.
So this is one of my favorite metaphors, and I'll talk about both just so people have the side by side. With the syndication, I think about it like a jumbo jet. You got the pilot, you got the co-pilot, you have the stewards and the stewardess working on the plane. Those folks are responsible for the operation of it, and then everybody else pays to get on. So when people syndicate, they pay money to be a part of the deal. And why do I say they pay money? If you put $1 into a syndication, you don't get $1 worth of equity out of that syndication. You get whatever the split is, 80%, 70%, whatever, you worked out with the general partners. With a joint venture, I consider that more like flying a fighter jet. And so everybody is responsible for something. Somebody may be a gunner, somebody may be flying the plane, somebody may be a navigator, whatever the different role is for that joint venture. But there isn't anybody that's just a passenger on the plane.
So there's no passive investor. Everyone has an active role in some aspect of the property.
Without question. And then, and that can, vary on the amount of active that they have. But the expectation is not that, hey, we're waiting on Jerome to go do this thing for us. It's we are all helping do this thing. And, Jerome's on the point, he's leading it, but we all have an active role. And so when we have meetings, everybody has a vote. If we're getting ready to sell the property, or if we're getting ready to do whatever strategic approach or conversation we're having, people are expected to participate and have input in those.
There's 5 of you in this joint venture. Do all 5 of you have an equal share, or is it weighted differently depending on how much participation you have?
We weighted based on cash in the deal on this one. In our subsequent deals, we have done it based on who brought the deal to the group, who signed the loan, and they got bumps in their equity for that. And then they also brought cash to the deal. And so with the joint venture, you can structure the ownership however you like. And what we've found as, I guess, fair is the best word, the way that I can describe it is, if you've, committed to some additional financial risk, or you did the work of finding the deal, you deserve an adder in addition to whatever capital you bring to the deal.
How do you make sure then that everyone's pulling their weight and actually earning their share of the equity?
I think that goes back to just being aligned. And so if you have aligned values, and one of my values is, the ability to speak plainly and clearly. If I don't think you're doing what you should be doing, or you're letting us down, it's a requirement that we have that conversation, and I have that conversation with you directly. And if I'm not doing my part, then you have that conversation with me. If we aren't able to speak freely to each other, then we've got bigger issues, and issues that will probably cause the relationship to dissolve. And so what we found is when people sweep things under the rug, eventually it gets so big that people trip over it.
Has that happened? And give us an example of that.
It has not happened in our partnerships, but we've seen it happen in other interactions. And again, I like to equate it to romantic relationships, right? If, you and your wife or somebody and their husband are, skipping over these little things that are pricking their nerve, and then eventually it erupts and they blow up. The issue is the exact same thing in these partnerships. We'll have conversations about, hey, this is a business plan, and then you're going through the execution of the business plan, you're going through the renovation and all the other things. Well, all right, we still don't have permits. Well, why don't we have permits? And having the conversation about why we don't have permits versus, trying to poke around or going to the permitting office to see if the permits have been applied for. Like, No, just ask the person that's responsible for permits if we have permits and why we don't have them if we don't have them. Like those types of things, instead of trying to go around under the guise of trust and verify or trust but verify, is what I think really destroy partnerships before they get started.
Yeah, I think you're absolutely correct. Communication is key. Making sure everyone understands what the expectations are and holding them accountable for those expectations. It's definitely important, especially when you have 5 people. I think that presents a lot of different personality dynamics that I'm sure can lead to some interesting arguments.
Yeah, and I mean, we had a diversity of age and just backgrounds in the group, and so that created some rubs too because everybody doesn't see the world the same way.
Well, tell us about your next acquisition. I mean, I know you ended up buying more multifamily and apartments. What was the next deal that you did?
So we did a 20 unit down in Greensboro, North Carolina, and we sourced that deal off of direct mail. Went over and met with the owner. And then I had some friends from high school and a partner of mine who was on a engineering board with me at a university, partner on that deal. Tons of learnings there. We thought we were buying the property with 4 vacants. And as soon as we closed, 3 people moved out in the middle of the night. And so our 20 unit went down to 13 people paying rent in the first month, which was challenging, but we worked through it.
Was it a similar model where you're buying a property with problems and then capturing the upside through renovation, rehab, and just repositioning your tenants?
Yeah, absolutely. So as you mentioned in the bio, we always buy apartments that are broken. And that's because we want to force the appreciation by increasing the net operating income. And so this property had low vacancy, a lot of deferred maintenance, and rents were about $125 on the market. And so the goal was to come in, renovate the vacant units, bring them to market rent, and then as the leases expired, renovate the additional units and bump all of those up to market rent as we could. I hired the wrong property manager. They didn't actually have the capacity to handle renovations that heavy. And so we ended up doing the first swath of renovations ourselves with my construction company. And then, we made some transitions and got a new property manager in who was able to execute against the business plan. They were also more aggressive on the rent. And so instead of getting $100, $125 rent premium, we ended up with I think it was $160 rent premium.
Nice. So the story that you told your lender, the bank, was it a similar story? I mean, how did they react to the story, and did they have any other challenges that they put in front of you as far as acquiring some sort of loan on this deal?
No. So the cool part about getting a experience or signing the loan is once you've signed the loan, now you're the expert. It's kind of like when I got my engineering license. On the day after I passed the test and the day before, I didn't know anything new. But I was licensed to stamp drawings on that next day. And so this lender has been great. We've done all of our deals in North Carolina with them. And we just tell them the story as we see it. This property is under market rent. They're able to go check that data. It's got deferred maintenance, and we've got a pretty good understanding of what that is. We've done an inspection, and they don't actually enjoy seeing the inspection report. They just want us to take care of it. We've got people in the deal that have significant cash reserves. In case something goes wrong, we can weather a storm and get to the other side, and the asset won't be at risk. They looked at the property management company and they kind of passed the eyeball test. And so, with all those things in place, we were able to go off and get them to come in with a 80% loan. This group didn't put any construction dollars in. We raised that as part of the partnership, and then went off to execute against a business plan.
So because you had a track record, you'd established a track record with your 22 unit of multifamily, they were a lot more willing to lend you more money on the second time around.
Yeah, absolutely. I mean, we had something to point to, and even though we were still going through the renovations on that one, they had confidence that we had the right skill set and ability to deliver on this project. And, it's worked really well. It's been really cool to see average rents go up each month and see the face of that building change when you start looking at vehicles in the parking lot, so on and so forth.
Was it the same ownership group as your first deal, or did you bring in new partners?
Totally new partners. One of our goals is to bring a new person into each deal to expose them to the opportunity of investing in multifamily properties. And if somebody wants to get the experience by signing a loan, we make sure that they own more than 20% of the deal so they get the opportunity to do that.
It seems like, though, if someone wants to come in on one of your deals, they can't just be a passive investor. They would have to have some sort of active participation.
Yeah, I mean, that's our preference because we want people to be engaged in the deal. As we start doing bigger deals, we're looking at some larger deals. We consider the syndication model, but we've really just been focused on helping people get into this space and get an opportunity to do deals that they probably wouldn't be able to do. Well, I know they wouldn't be able to do with bank financing on their own.
And I want to talk a little bit about the Myers method, because you've developed a Myers method that I know has certain steps and processes to it. Can you share some of that with our listeners?
You know, one of my dear friends and coach is a guy named James Bryan, and he's been in just about every deal with me. And as we get more methodical in our approach to buying property, you know, he's like, man, we're using the Myers methods to buy this property. I'm like, what are you talking about? He's like, think about it. We do the same thing and look at it the same way every single time. And only the deals that check all the boxes actually make it through. And so last year in June, we did our first kind of seminar, and we did it digitally so people could chime in. And then we built out a full course and some other stuff, but it's just at the highest level. You know, we find deals, we fund deals, we fix them, and then we flip them. Finding a deal is, you know, all the techniques and strategies that wholesalers use. You can direct mail, you can call, you can look on MLS or whatever the commercial variant is that is. For funding deals, this is your due diligence period. So this is, you know, when you find out whether you actually have a deal or not. And then you create your business plan after identifying the specific problems that you want to solve for, and bring partners to the deal so that you can pay for the down payment. And then the next piece is fixing it. And, you know, a lot of people, I think, miss this part of the conversation, especially the way that multifamily has been sensationalized. You spend 6 months at the most in the finding and funding phase of the process. You keep the deal for probably 60 months. But everybody wants to focus on finding deals and getting money for deals. We focus on being great operators. And so this is where you actually make your money in the value creation piece of it. You can't make any money if you bought the property wrong, but if you don't execute the business plan, you won't force NOI, which will not net your increase in valuation and create the equity for you. And then the final piece is flipping it. And that can be either refinancing it or selling it. And so when we refi, we look to get all of the original down payment out. It's similar to the BRRRR method that everybody's talking about with single families. And then we can just enjoy the cash flow and the infinity return on money invested. Or we can sell it to somebody else who wants to take advantage of a property that's operating well.
And how many times have you actually engaged the Myers method?
We've been full cycle on 3 deals. And then we're in the process of another couple right now. But, you know, the first piece of it, we've, I don't know, probably 20 or 30 times as we've gotten to a place where, you know, we found a deal that we've almost liked. Maybe we couldn't negotiate the terms we wanted, so we had to get out, or we get into due diligence and we had to back out of that deal. And so, you know, different fits and starts, but, you know, actually get into the backside of it is, you know, it's a much smaller number.
What are some of your buying parameters? I mean, what are you looking for in a deal? And do you expect that to change now that the economy is really taking a dive because of the coronavirus?
I'm probably overly optimistic in, you know, what's going to happen on the backside of the restrictions on travel and some of the other things related to coronavirus. Do I expect our deal filter to change? I don't think so. I think we're still going to be looking for deals where we can grow rents that are, you know, at least $100. especially if there's some type of renovation play. We look for properties that are in growing areas. We particularly like Richmond, Virginia, and Greensboro, North Carolina, because we already have assets there. But the principles of our process work anywhere. We look for properties that haven't been updated recently, and they have an issue that's easily identifiable through looking through the profit and loss statement. And so that can be vacancies high and figuring out what would drive vacancy. There could be operational expenses that are out of whack and figuring out how to bring those back in line with what we would expect for a property of that size and type. And so we're going to continue to look for properties where we can force appreciation. And I'm not somebody who's overly optimistic that there's going to be a bunch of blood in the street when it comes to this situation. I think everybody's stepping up and taking a piece of the burden, and I think it's going to help property owners get through those tough times. And if that's the case, they don't become motivated sellers.
What are some of the opportunities and upside you usually identify in these types of properties? I mean, problems that you see that you can go in and fix. Give us some specific examples.
Yeah, so we bought a property in February of last year where they were trying to use it as a college rental. And so they were renting by the bedroom. So this property is 26 doors, have 52 bedrooms. And so they have 52 leases. What was happening is people would lease half of a unit and they wouldn't bring a roommate. And so the rents here were $820 or $840, something like that. And so you would be getting half a month's rent and everything was included: water, electricity, internet, and gas. And so if you're only getting $400 a month, there's no way that you're able to service the debt from that unit. So what we did was we came in, we eliminated all of the half occupied units, and we transitioned the leases to one lease per door. This allowed, and then in addition to changing it to one lease per door, we also gave people the opportunity to pay their own electric and water, gas, and gas bills. We still carry the internet as kind of an amenity for the property. But by doing those things, we were able to drop $20,000 to the bottom line last year, and we expect to do another $30,000 or so this year as we, fully get the benefit of making that transition in the way the property is released. And so the business plan here was, reduce vacancy because you're not collecting just half month's rent, and then move some of the expenses from the landlord side to the resident side.
It's really interesting that just by doing something as simple as changing your approach from renting by the bed to renting by the unit, you were able to just, almost double your gross income because of that.
Yeah, I mean, that is, it's exciting. And then the other thing that we did, because I think we model pretty conservatively, is we dropped the rents by $100 in order to accommodate or, I guess give us some cushion in case people didn't want to pay full market rent and pay their own utilities. And it worked out where for the townhomes at that property, they were more than willing to pay market rent and their utilities.
It's interesting that when it comes down to the decisions we make as rental property owners, you made the decision on your first multifamily to go all in and completely rehab the units. And that made a huge difference on the upside. This other property, the previous owner had made the decision to rent by the bedroom. And that made a completely opposite result for them, where they ended up losing the property because of that. Have you ever made the wrong decision and really had to pivot because you realized, oops, we made a mistake?
Yeah, I think on the second property we bought, the 20 unit that we've already talked about, one of the mistakes that we made was underestimating how many units we were going to renovate. We thought we were going to renovate 4, maybe 5 in the first year, and we renovated 13. And so that was a drain on our cash, and it wasn't comfortable. But, once you're in the project, you got to finish, right? And so you just feed the beast. And while the renovations were, the total capital expenditure cost was higher than what we expected, it also allowed us to grow our income pretty dramatically. And so that was probably well worth it. And now we're in a position where we can do one or two things. We can exit or we can refi and get all of our cash out.
Good lesson there. I always feel like when you buy a property that's underperforming, you have to go in strong, which means you have to have enough money to cover those unexpected vacancies. But I also feel like your vacancies, I mean, experience has proven this to me, your vacancies are always going to end up being higher because as the poor tenants see that new management has come in and is changing the feel and the look of the property and the tone of the property, they're going to say, you know what, I don't belong here anymore. So I'm going to go find a place where I do belong. And then you're going to have those vacancies. You're going to have increased vacancy because of it.
The one thing that I've seen that happens before that is they try to buck the trend. And so the new people move in and they might do a little bit to terrorize the new people to make them not want to be there. Say things like, you're parking in my parking space, or sitting on their front porch and playing loud music or being boisterous. Like those types of things happen. And then, they get the notice, hey, you can't do that. That's not acceptable. Then they might make that transition. But first it's, hey, you're invading my territory. Let me see if I can do something to make you move away.
First comes denial. It's like the 7 stages of grief, only it's the 7 stages of realizing that you're no longer welcome in your own apartment complex. Denial, and then eventually acceptance. But I want to, as we wrap it up, I want to talk a little bit about the training and the education that you provide, because I know that you're also an instructor and an educator as well. Can you talk a little bit about that?
The podcast, Myers Methods Presents Multifamily Missteps, is real stories from real operators. And the goal is to give people the opportunity to come into the space eyes wide open. I think a lot of folks have romanticized what investing in multifamily is, and they pretend like their business plan goes as planned every single time. And there's so much that you learn once you get into the space. And so we've had people from all over the country come onto the podcast and share their story. And so that I'm super excited about. On the backside of that, I think every investor has 4 things that they struggle with. The first is knowledge. After knowledge is deal flow. Following deal flow is experience. And then that's followed up by capital. And we think about these kind of like a pyramid. And so you want knowledge so that you actually talk the talk and walk the walk. If you have knowledge, you'll get the opportunity to look at some deals, but you don't need deals until you have knowledge, because you won't know what you're looking at. I think a lot of people confuse leads and deals. They have the same letters, guys, but they're not the same thing. And so you want to apply that knowledge against your leads to find a deal. After you have a deal, you need experience, because you're not going to be able to get debt without experience. And so we created a community around the Myers Methods of Multifamily Investing. And the whole thing is we've got like values, and we've kind of created this place where this ecosystem where people can come meet each other and that think about investing the same way. And so, that's part of the community. It's $29 a month. We curate some content in there, but it's opportunity to meet people who've done deals, people who are looking to do deals, and people who have, experience and money and willing to partner with other folks to get into the space. And then, capital, I think, is the biggest one. And many people think, hey, I can't invest in multifamily investing without capital. And that part is true, but there's 3 other steps that I think you need to go through before you ever need to worry about capital. And the fact of the matter is smart capital is always looking for experience in deals. And so if you have a deal, you can attract the experience, because experience is also looking for deals. And then when the experience is attracted to your deal, the capital will follow. I think people have always said, hey, if you've got a good deal, the money will show up. That statement is partially true. I think the rest of the statement is, if you have a good deal and you've got somebody that can actually execute the business plan as a part of that deal, then the money will follow. And so, we've tried to help people with 3 of the 4 pieces of those challenges. We skip deal flow because we think that's the real opportunity for somebody with little experience to go do by themselves. And it keeps them from getting in a pickle. Because you can't close a deal, you can't really lose any money. Some people may try to put some stuff under contract, but that you'll find out pretty quickly if you can actually close that deal as it's contracted, which keeps people from losing money. One of the things that's a pet peeve for me is people going out and spending $30,000 to $50,000 to get education, and the percent of those folks who actually do a deal is really small. It's our goal to help people get experience at a lower entry point and then decide whether or not they want to be in the business. And if they do, and they feel like those folks that are charging more for their money or more for the knowledge and the network, then they can actually go and move to that new space. But I think the law of the first deal is a real thing. And, being that the first deal is the hardest, and then the ones that follow are quicker and easier and usually larger than the first one. And so we want to help people get into that first deal or that second deal. And then if they decide that they've grown too large for the community or want to do deals that they couldn't do with the groups that are the people that are in this network, then they can go off and buy into another network. But for the vast majority of people, the thought of them going out and killing Moby Dick on their first deal, right, where they go take down this $10 million 100-unit deal, just doesn't seem realistic to me. And I think the data is pretty clear that it doesn't happen very often.
I started off your introduction by referencing the movie The Matrix. And I know that that's an influential movie for you, and you like to relate it to real estate investing. And I wonder if it has anything to do with you breaking out of your corporate career and background as a military kid, and any challenges you may have had to overcome from that. Can you just kind of fill us in on why that movie is important and how you do relate it to real estate investing?
Yeah, I mean, it was one of those, people talk about quake books. This was a quake movie for me. It shook everything up. The reality of the situation is, like, all of us have dreams as kids. And, whether it's the poster on the wall, whether it's pretending and imagining something out in the yard, whatever it is, we all have dreams. And we go through life and our dreams get beat out of us. We get told to be realistic. We get told we have responsibility and we can't do this or that. And it's just not true. Like, the reality is your dreams should be real. And you guys that are listening and got to this place in the interview, you're now responsible for that. Your dreams should be real. And you just have to be willing to take responsibility for that and question everything that you've been told and get to a place where you have a frame of mind where it empowers you and encourages you to go down the path that, you desire most. I think there are a ton of people doing things that they're dispassionate about just because it pays a good paycheck. And if we can create a revenue stream instead of a job, as we talked about earlier, then people can go out and work in their passion. I'm not saying that people need to exit the workforce in order to go lay on the beach. I'm saying that if you've got these passion projects that you can't get to because you have a job that is so demanding that you don't have any energy to work on something outside of what you're doing on autopilot, then there's something wrong with that picture. And that I believe the world becomes a much better place when we as individuals are working in our genius zone and giving gifts to the world that we're choosing not to give the world because we are so enamored in this structure and rigor of the day to day. And so, I took the red pill and I'm going all the way as far as I can. And I want to, in turn, be Morpheus for all those folks who want to exit the matrix as well.
What were you told that turned out to be wrong once you figured out the whole matrix?
One of the most beautiful moments I had with my mom as a child was telling her that I wanted to be a garbage man. Lonnie, me and my mom used to lay on a blanket on the side of the house just about, every day when the weather was nice. And I played with my Tonka trucks and all the other boy things that were out there. And on trash day, Lonnie would be hanging off the back of the trash truck. And he'd grab the trash can, throw it in, pull the lever down. I hear the crunching and all the sounds. It's like, man, that's it. And then the flip side of that was he was home every day at 2 or 3 o'clock in the afternoon. And my dad would get up. He'd go to PT at 5:30. He wouldn't get back till 6 o'clock. He called it a Carolina half day. And it was we had to wait for my dad to come home for dinner. And sometimes I would be hungry, and I didn't like the fact that it always took him so long to come home. But, that was the structure, that was a certainty piece for them. My mom told me you can't have the Nikes and all the other stuff that you want if you're a trash man. She said you have to dream bigger. You want to own the company, and then you can be on the truck when you want to. What was wrong in that wisdom was that I needed a job, that I had to pick a certain discipline in order to provide the lifestyle that I wanted. I needed to create a stream of revenue. And it wasn't until I got to college that I realized that you could decouple time for money. I always thought that you had to trade hours for dollars. And now I live in a space where my time is decoupled from the money and I'm able to be free. And I want as many people as possible to enjoy that part of life.
Jerome, how would people get a hold of you if they wanted to do so?
For those folks who are interested in education, we're giving away a free 4-step guide on myersmethods.com. I encourage everybody that's interested in investing, whether it's multifamily or not, to check out the podcast, Multifamily Missteps, because it tells you about things that can be applied across all the different asset classes. And so, that's available on YouTube and all the major podcasting platforms. And then I'm on LinkedIn, man. Anybody can find me on LinkedIn. Last name spelled Myers. And I'm really active there and would love to connect with folks there.
And you have a second podcast as well, don't you?
I do. It's called Dreamcatchers. And, we tell the stories of people that have exited the matrix. And the whole hope of it is to inspire folks to actually take that next step to get closer, as well as to give them the tools and tactics to actually execute against that plan if that's what they want to do.
Well, Jerome, it's been great talking with you. I really appreciate you sharing your experiences of rehabbing and upgrading the apartment complexes and multifamilies that you've done. Just knowing how to tell the story to the lenders, how to work with partners and the way you joint venture as opposed to syndicate. That's all been very interesting. And I think we've also hopefully learned a little bit about escaping the matrix and what that really means. So thank you so much for having this conversation with us.
And this was awesome. This was probably one of the most in-depth interviews I've done so far. And I'm just grateful for you sharing your platform with me.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.